What if you could tell your phone bill to pay itself, or your internet bill, or that streaming service you forgot you even had? Imagine a world where, every single month, a nice little chunk of cash just shows up in your account. No questions asked. It's not your salary. It's not a side hustle. It's your money, making more money for you. This is the dream of dividend income. Like a tiny employee who never sleeps, never complains, and just hands you cash. The goal, $500 a month. That's $6,000 a year. Sounds like a lot, but you can plan for it. This isn't a get-rich-quick pop-up ad. No, this is a plan. It requires patience, some saving, and understanding a few simple ideas. Not rocket science, no fancy finance degree, no secret Wall Street password. The point, your investments pay you back, regularly, like a punctual friend who always buys coffee. $6,000 a year is our North Star. It's the destination on our GPS. Once you know where you're going, you need the map. This idea isn't just money, it's freedom. Think what $500 could do. Cover a car payment. Pay all your groceries for a month. Be fun money, guilt-free. Because it's extra income your portfolio generated on its own. Not replacing your job overnight. It's the first step to financial independence. Let's build this money machine. It's straightforward. Buy pieces of companies, stocks, or buy into a basket, a fund. Many companies, when profitable, share a small piece with shareholders. That's you. That shared profit is a dividend. All right, let's get out our calculators. Don't worry, the math is so simple you can do it on your phone while waiting for your food order. The most important term you need to know is dividend yield. It sounds technical, but it's just a percentage that shows how much cash a company pays you each year compared to its stock price. Example, a $100 stock with a 3% yield pays $3 per year. Simple. To figure out how much money you need to invest to get your $6,000 a year, you just divide your target income by that yield. $6,000 yield percent versus our total investment needed. Let's break it down with a few different scenarios. Slow and steady, slightly more adventurous. First up, the 3% yield. Sensible, reliable, the Toyota of the dividend world. It's not flashy, but it's safe and gets you where you need to go. To get $6,000 a year from a 3% yield, the math is 6,000 divided by 0.03. That gives you a grand total of 200,000. This is the amount of money you'd need invested in assets that pay, on average, a 3% dividend. Index funds tracking the S&P 500, Schwab U.S. Dividend Equity ETF, SCHD. They offer stability and growth along with their income. Now let's dial it up a notch to a 4% yield. This is a very popular target for dividend investors. It's the sweet spot between safety and a little extra income. The math here is 6,000 divided by 0.04, which equals 150,000. See how the total amount you need to invest just dropped by 50,000? That's the power of a slightly higher yield. To get this kind of return, you might look at funds that focus on income, like Vanguard High Dividend Yield ETF, VYM. These funds hold companies that pay consistently higher than average dividends, giving you more cash flow. Feeling a bit more ambitious? Let's look at a 5% yield. Now we're getting into territory that's more income-focused. The calculation is 6,000 divided by 0.05, which brings our target investment down to 120,000. This is a significant drop from the 200,000 we started with. To find yields like this, you might explore specific high-yield funds or pick individual stocks. Real estate investment trusts, REITs, utility stocks, Global X Super Dividend ETF, SDIV. Though as we'll see, this is where you need to start paying closer attention. The higher the yield, the more homework you have to do. What if you found a 7% yield? 6,000 divided by 0.07 comes out to roughly 85,714. That sounds amazing, right? It's tempting, but shortcuts can lead to a traffic jam or worse, off a cliff. A super high dividend yield can be a warning sign. a big red flag. Often the yield is high not because the company is generous, but because the stock price has fallen off a cliff. Yield, Rostocci annual dividend, current stock price. If the stock price plummets, but the dividend hasn't been cut yet, the yield percentage shoots up. It can look attractive, but may mean the company is in deep trouble and the dividend could be next. A 3 to 4% dividend from a solid company is like a marathon runner. Endurance for the long haul, maybe speeding up each year. A questionable 10-12% yield is like a sprinter about to pull a hamstring. You might get a few big payments, but you risk losing a huge chunk of your principal if the company collapses or slashes its dividend to zero. Focus on quality and consistency, not flashy yields. Companies that pay and grow dividends year after year. Dividend aristocrats, dividend kings. Boring, predictable businesses selling things people need. Toothpaste, soda, electricity. Their yields aren't the highest, but they're dependable. A growing dividend from a strong company outperforms a risky high yield over time. Build on rock, not sand. Section 5. The slow cooker method. Building your dividend machine. You know the goal, $6,000 per year. You know the math, divide by the yield. You know the risks. Don't chase crazy high yields. How do you actually build up that nest egg? The answer is the slow cooker method. A little bit at a time, over a long time. It's about consistency, automating your savings, letting time and compounding do the heavy lifting. Say you save and invest $500 every single month into a diversified portfolio. Assume an average total return of 8% per year. After 1 year, around $6,250. Year 5, over $37,000. Year 10, near $92,000. Around year 11 or 12, you may cross $120,000. At that point, if your portfolio has a 5% yield, you've hit your goal. You are now generating $500 a month in passive income. In the later years, returns could add more than your own $500 monthly contributions. The slow, steady path wins, even when the market is scary. Section 6. The payoff. What $500 a month really means. So, you did it. You followed the plan. You were patient. You saved consistently. You focused on quality. And now, every month, an extra $500 lands in your bank account. $500 a month in dividends won't make you rich, but it can pay your phone bill, groceries, or car note. Forever. If you want a breakdown for $1,000, $3,000, or $10,000 a month, subscribe to Smart Money and Mind, where we roast bad money habits and build real wealth.